Welcome to the Wealth Steading Podcast. This is episode 471. Today is May 18th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Wait, today I want to do a quick market review, and specifically I want to talk about a dozen or more stocks that are not only high quality, but have also been consistent outperformers in the stock market. And I want to make the argument that I think that trend is likely to continue regardless of any naysaying or bad news. And before we get in all that, let's talk about the bad news. On Friday after the market closed, Moody's downgraded the U.S. debt from AAA. Probably a lot will be made of that this week. There may be some panic. I don't know. I don't think it's any more significant. In fact, less significant than when S&P Global downgraded U.S. debt. I mean, that was a big stir in the market, but you know what? That was 14 years ago. Yeah, and what's become of it? Nothing. The United States, for all of its problems, it remains the best house in a bad neighborhood. If you don't agree with that, you really shouldn't listen to my podcast, because I believe not only in the strength and resilience of the United States economy, but even more generally of North America. And in fact, you'll hear me talk in probably a soon-to-be-released episode about Fortress North America, which is really going to emphasize some strengths in Canada and Mexico. And that's fallen under the headlines lately because of the tariffs that have been placed on the north and south border countries. But listen, there has been and there will be no other geography like North America. And if you had to place one bet on a growing, resilient, long-term economy, that's where you want to put it. Again, if you don't agree with me, I'm not going to argue. I'm just telling you that's where my money primarily is and will remain. And if I didn't think that way, I wouldn't live in North America, right? I'd move to Beijing or Berlin or Bangkok or Barcelona or Bucharest. Anyways, you get the point. But the bottom line is this market remains resilient. And the naysayers that panicked over the previous few months and sold, well, they obviously sold at the bottom. You heard me saying back in, February, March, when the market was falling apart, to watch those levels on the S&P 500 around 5,500. I thought that was a level that could have held. That was initially when we went into a double bottom scenario. But after the big April 2nd announcement on tariffs, the market really fell apart. And again, don't get me wrong here. I can't predict the future. I don't know that the market won't fall apart as we get into the summer and more issues come up with debt resolution and tax cuts. And who knows whatever nonsense comes out of the White House and what goofy interpretations the media has of it. But again, I think these are short-term road bumps in the overall long-term upward trajectory of the United States economy. Look at the S&P 500 over these past couple months. Yeah, it dropped down below that 5,000 point level, but it wasn't even 3 weeks or so before it had a V-shaped bottom and bounced back up well above those levels. Right now, the price on the S&P 500 is above all the key moving averages. The 50-day, the 100-day, the 200-day, all solidly above all of those. In fact, you're seeing a convergence right now, right around the 57.70 level, where the 200 and the 100-day moving average are converging and moving together. It won't be long till the 50-day moving average is at that level or above it. And what that means is that we're likely to have a great deal of support above that 57.70 level. Now, again, it doesn't mean it can't drop below that. It can't mean that some insanely stupid thing will be said by a major politician here in the coming days or weeks. But just like we saw throughout April, this is all political theater and drama. And profitable companies are holding up in their value. And I want to get to several of those in just a minute here. Before I do, again, one more thing about the general market. And that's not only has the S&P 500 snapped back, but we're seeing broader, better overall performance. Now, in the last week or so, yeah, some of the big names have really outperformed because so many people panicked and got out of them. Now they all have to jump back into them. But specifically, over the last month, the mid-cap stocks, these are not the big names that you hear every day, they have held up 100% every bit as well as the big S&P 500. I think that's a really good sign because over the last 2 or 3 years, in a lot of cases, the mid-cap stocks have well underperformed. And generally, when you are in a long-term uptrend, initially, once the economy gets fired up, those mid-cap stocks tend to outperform the S&P 500 because they had been underinvested in and because that's generally where the growth is going to be. And a lot of times, those mid-cap stocks either grow to be large-cap stocks or they get acquired. And I think with a lot of the deregulation that we're seeing, we will see much more mergers and acquisitions in the coming years than we've seen over the last 5 or 6. So again, I think that fares well for the mid-cap stocks, and they are holding up well. And then even more broadly, if you look at the equal weight S&P 500, not just the traditional S&P 500, which is dominated by a handful to a dozen big names, but the equal weight S&P 500 over the last 3 months, during this crucial period from when everything fell apart on April 2nd when the tariffs were announced, to even really prior than that, going into that, the equal weight broader market was outperforming the S&P 500. It held up better on the retribution day. And since then, again, gauge it over the last 3 months, the broader market, the equal weight S&P 500, has outperformed, meaning all those big names of the Magnificent Seven that you're always hearing about, they have performed not as well as the broader market within the S&P 500. That's a good sign for a growing, thriving, resilient economy. Now, again, if you're a naysayer, you don't agree with me, you've probably stopped listening 30 seconds into the podcast. But for those of you that are sticking around, I'm going to run down a list of stocks that have been consistent outperformers. I think they're going to continue with that trend. But I know there's still a couple of you guys that are on the fence and you're worried that, oh my goodness, we're at 59, 58 on the S&P 500. It's almost back to 6,000. And last time we got just a little bit above 6,000 on the S&P 500 and the market fell apart. And, maybe that's going to happen again. Well, maybe it will. But you know what? The naysayers that are uncomfortable at the 6,000 level on the S&P 500, I guarantee you, they're the same people that were uncomfortable at 5,000 and at 4,000 and at 3,000. So again, if you're looking for a place to invest, you're going to be hard-pressed to find something long-term that's better than the U.S. economy. Now, specifically to stocks that have held up well, and again, I think we'll continue that trend. I'm going to go over this list. The ones I'm going to talk about, I could talk about 50 or 100 of them, but I'm going to narrow this down to maybe a dozen or so, probably a little bit more. Full disclosure here, the ones I'm going to talk about, these are ones that are specifically in my portfolio. Now again, I could talk about other stocks that are similar to these, but I want to highlight the fact that I'm not only giving you an opinion, because I hate whenever you read these mainstream news articles about finance and they'll tell you about these 5 fantastic stocks that you should own, and then a little print at the bottom of the article it'll say that the author doesn't have any positions in those stocks. Well, listen, if you thought the stocks were so good, why wouldn't you own them? So I'm not only giving you an opinion, I'm giving you my positions. And let me go through these in no particular order other than I guess I'll group them by the overall sector or industry they're in. Well, let's start with 2 names that everybody's familiar with, Uber and Netflix. These 2 stocks over the last 12 months have day in, day out consistently beat or outperformed the S&P 500 in relative terms. So it doesn't mean that they haven't been down over the last 12 months. It just means that if they did go down, they didn't go down as much as the S&P 500. And actually, what I'm saying is going to be true with every stock that I talk about today. But specifically to Uber and Netflix, think of how many times over the last year or longer you've heard that Uber was about to go out of business, right? They were going to get regulated out of business, or some other technology, something like Tesla was going to take over from them, or just on and on. Well, that isn't the case. Uber has held up, and sure, it has its ups and downs, but it, again, has consistently over the last week, over the last month, over the last 3 months, over the last 6 months, over the last 12 months, it has outperformed the S&P 500 just as Netflix has. And Netflix is the same way. You've heard probably for the last decade how Netflix was going to get knocked out of its top position from being the streaming giant that it is. And even, myself, I've been very skeptical that Netflix could continue the long run that it's had, but it does continue to beat and outperform the S&P 500. And when you think of both of those stocks, what do they have in common? Well, really, they're just apps, right? They're software applications that help consumers consolidate and buy particular products. In the case of Netflix, you're really just using a big app that allows you to find the entertainment you want. And in the case of Uber, you're finding a ride. That's a big theme I want to talk about. Look for stocks or companies that are finding a way to digitize an otherwise analog economy and provide you a product or service through some type of an app. That's obviously been a trend for a long time. It's going to continue. Let's go on to another category of stocks. Been big performers as an overall category for really post-pandemic now consistently. And it deals with that overall digitization and electrification trend. And that's companies like GE Vernova, Jabil, Flex, Amphenol, and I'll throw in Rockwell Automation in that mix as well. Rockwell Automation, obviously, as the name implies, it's more about automation equipment, but in general, every company that I just named is somehow involved in electrification or the power grid. GE Vernova, specifically, manufactures electric power generation equipment. Jabil is a electronics manufacturer, printed circuit boards, assembling type company, based here in the U.S., by the way. Flex makes electronic components, as does Amphenol. And Amphenol is a long-term old name. I don't know. They may have been in business for 100 years or more at this point. I don't remember exactly how old they are, but this company has been phenomenal in the fact that they consistently reinvent themselves in staying on the cutting edge when it comes to electronic and electrical connectivity. So fiber optics, sensors, cabling, anything to do with precision, electrical and electronic connectors, those guys are always on the cutting edge of it. Again, they've been in business for a long, long time. They've been successful. I think they will continue to be successful in the future. And that last list, these last 5 or so companies I just mentioned, again, they have outperformed the S&P 500 over the last week, over the last month, over the last 3 months, over the last 6 months, and over the last 12 months. I expect that overall electrification and power generation and electrical conductivity trend to continue. And speaking of that, and very much related to it, Johnson Control and Trane, and I could name a couple others, but those two specifically are heavily into HVAC. They've been thriving in the post-pandemic environment. Again, I think they will continue to grow and expand in coming years. And the big reason that they're doing so well is not only just, HVAC components, and I'm talking heating, ventilation, and air conditioning, not only in terms of residential and commercial properties, but specifically in these big data centers. These data centers have to have a controlled environment, mostly on the side of cooling, dissipating all the heat. And companies like Trane and Johnson Control are big suppliers to that sector. Here's another group that you may not normally be thinking about, and one of them in particular has been a dog for years, but that's the aerospace industry. Howmet Aerospace, Carpenter Technology, GE Aerospace, and then the dog of them all, Boeing. Boeing is finally starting to break out from a, 6 or 7 year downturn. One thing you may not know about aerospace is that the United States' largest export is aerospace products, and specifically Boeing jets. And so with all the deals that are going down right now in the Middle East, where they're buying our equipment and, with some of the rescinding of the tariffs, where the Chinese have renewed their contracts with Boeing, that is not only helping Boeing stock rise, but these others as well. GE Aerospace manufactures the engine for Boeing aircraft. Carpenter Technologies and Howmet are both involved with the metal fabrication of components and engineered fasteners and such. So commercial aerospace is alive and well, and then I'm not even talking about it, but think about the defense nature that comes into this We live in a dangerous world, and those aerospace companies that focus even more so on military aircraft and missiles and drones and defense, they're obviously, and their supply chains are continuing to grow as well. Now, stepping back from that, let's look at some totally different industries. And again, I'm just going to highlight a couple of these. HCA Healthcare. This is a healthcare provider. They own hospitals and facilities, primarily over on the Southern Atlantic region. HCA in particular is doing very well because it's recovering from the downturn that it had following the devastating hurricanes that hit that area, later last year. But even with all the turmoil that it's gone through, again, over the last week, month, 3 months, 6 months, and 12 months, HCA has had strong relative performance against the S&P 500. Another company that fits in that category, and this is a long-term stock that I've enjoyed owning on and off for probably 2 decades or more, it's Performance Food Group. They provide fresh produce to the restaurant industry. So, the lettuce at Taco Bell and the tomato on your Whopper, that comes from Performance Food Group. The beautiful part about a company like this and why they continue to be so resilient over the years, regardless of the economy, is that they're selling food to restaurants, which, yes, that's consumer cyclical and that can go down in a recession. But the bottom line is people do like to eat out, and Performance Food Group is selling a perishable product. It's produce. It withers and it is no good within 2 or 3 days. So there's no shelf life. It constantly has to be replenished. The company has been a good long-term performer. I expect it to be that way into the future. And speaking of good long-term performers, here's another stock that I've owned in and out over the last decade or more, and that's Westinghouse Air Brake. They primarily make engines and locomotives for the railroad industry. If you remember me talking about my portfolio, I own 3 or 4 of the actual railroad companies. I think railroads are an excellent long-term investment for many reasons. We should probably have a specific episode about that, but just today drilling it down for Westinghouse Air Brake. They are the dominant manufacturer for locomotives, and if even a global economy shuts off the U.S., Westinghouse Air Brake will, at a minimum, continue to make locomotives for the North American market. Again, another company that's been around for decades and decades, and even during all this turmoil over the recent months, again, this company has had better relative performance than the S&P 500 over the last week, month, 3 months, 6 months, and 12 months. Doesn't mean they won't go down tomorrow, but they are a consistent long-term performer. And then finally, I want to wrap up on Cisco, and I'm talking Cisco with the C, the Internet and Networking Equipment Company, and of course they've over the years expanded into services, things like cybersecurity. I wanted to mention Cisco because they were the quintessential bomb of the dot-com bubble. Back in the day in 1999, they were one of the top companies, I think maybe even the top company of market capitalization back then. Everybody was basing internet hopes on their company. Their price exploded, and I don't think even all these years later they've ever gotten back to the highs that they put in back in 1999 or 2000 when the internet bubble blew up. That's a case to be made to not get wrapped up in irrational exuberance and the trends at the time, and to not concentrate and put all your wealth into 1 or 2 stocks or even just 1 or 2 industries or sectors. But again, look at Cisco over these years. As long as you didn't own them during the peak, they have been a long-term performer. And again, over the last week and month and 3 months and 6 months and 12 months, Cisco has had better relative performance than the overall S&P 500. I think that is going to continue because it aligns with the other trends that we talked about in terms of digitization and automation and overall the expansion of artificial intelligence. I think Cisco is going to be a dominant player in that area. Now, I'm not running out and telling you to buy these stocks. I'm just telling you that I already own them and I have no intent at this point of selling them. A few of them have exploded extremely high over the last 12 months. GE Vernova up I think close to 130% in the last 12 months. Carpenter Technologies close to 90% in the last 12 months. Howmet and Netflix, again, over the last 12 months, up well over 70%. So could they have somewhat of a pullback? Well, they could, but those stocks have recovered extremely well just over the last month, and even this week, they're all up significantly. Carpenter was up almost 10% this week alone. So if you're worried about those ones that have performed so well over the last year, you might want to back off a little bit, but look at Boeing. Boeing has pretty much been an underperformer since before the pandemic, right? They went into a tailspin 2018, 2019 timeframe. They're pulling out of it. They're pretty much flat for the last year, but just in the last 3 months, they're up over 14%. They're up over 12% in the last month and up close to 6% just this past week alone. My point here is that there are opportunities throughout the stock market, and regardless of the nonsense that may or may not come out of the media or come out of the White House, I just ignore it and I look at good quality stocks to own, and I want to own those now and into the future. Well, hey, as always, until next time, this is John Pugliano wishing you the very best returns.